All right, and Gilles, what are some of the factors to consider in order to minimize the tax burden and still be tax compliant?
Okay, well, thanks, Lee, but maybe just before, I move to that to answer to that question, getting back on what I was saying a few minutes ago about OADA, and in fact, there was initially 14 countries which signed the treaty, and then you had 2 countries, Comoros and Guinea, who subsequently decided to join, and finally the DRC also joined OADA, I think a year or maybe like 2 years ago. So that as of today, in fact, we have 16 African countries which have joined the OADA space. And I think it's worth spending a few minutes on OADA because it's really the idea of providing security to foreign investors. And kind of the beauty of OADA is that once you understand how you do business in Cameroon, for example, where you can replicate and you will find exactly the same type of business vehicle and like the branch and companies and SARL and SAS will operate exactly in the same way in 16 different countries, in fact, in Africa, mainly French-speaking country. And once again, the OADA rules are very similar to the French law. Now, getting back to your question, Lee, obviously the one of the criteria is to make sure, that whatever taxes that needs to be paid are paid, and that groups deciding to operate in Africa are fully compliant with the tax regulation and the tax requirement. And I think just because it is a good thing to do, and also because the cost of being non-compliant are very significant, as we will see in terms of penalties and late interest payments. But even if it's the right thing to do to pay whatever taxes needs to be made, there are also some techniques, perfectly legal techniques, that can allow a taxpayer to reduce the effective tax rate. Maybe moving to the next slide. This is something that Omoike has already touched. Are the double taxation agreements, are agreements, in fact, that were signed between states. Like to give you an example, like sitting today in Cameroon, there is a double tax treaty agreement between Cameroon and France, and these treaties, in fact, provides a definition on, for example, what is a dividend, what is a royalty, how to define interest. Without getting too much into the technique, what is a permanent establishment, and is there, like, for example, a threshold when a company operating from outside Africa should pay taxes in that specific country because it is viewed as having a permanent establishment. Once again, the treaty provides a definition, and then this slide, and then the treaty also will let the investor know in advance where the income, in fact, will be subject to tax. The main objective, in fact, of this double tax treaty is to avoid double taxation, so that, for example, getting back to my example, about the France-Cameroon double tax treaty, a group should have tax in France or in Cameroon, but certainly not pay tax twice on the same revenue. Obviously, it will kill out the expected return on investment. So as Omoike mentioned, a few minutes ago, the tax treaty network in Africa is not very large. The devil, obviously, is always in the details, and you will see countries like South Africa, for example, or Mauritius, which are really fighting to be viewed as the gateway into Africa, with Morocco as well, being a new player. So these three countries, South Africa, Mauritius, and Morocco, are negotiating, in fact, a double taxation agreement in order to attract investment into their own country. To the opposite, you have a country like Angola, for example, which as of today doesn't have any valid in the sense in-force treaty. I have heard that they are currently negotiating one with Portugal, but it's going to take some time before that treaty gets into force.
Let me just step in very quickly from talking about the double taxation network in Africa. We'll move on to other compliance issues that are important for you to take note of when doing business in Africa. Once you are set up to do business in Africa, then the next thing is to register. Taxpayers are required to have an identification number for corporate income tax purposes and for VAT, value-added tax purposes. This is, you find it's common amongst the jurisdictions. So carrying on business in Africa will require annual, quarterly, or monthly compliance. For example, in some jurisdictions, value-added tax compliance is required to be done on a monthly basis. In some other jurisdictions, it's done on a bi-monthly basis or quarterly basis. Yeah, but corporate returns are required to be done on an annual basis, where you also are required to have an audited financial statement to support the numbers that you are submitting to the tax authorities for your tax returns. Also, if you have people coming into Africa for business, then also note that they are required to tax returns and file those returns on a monthly basis, right? Again, presently Africa is trying to move to electronic filing system. It is not very successful in a lot of countries, but South Africa, Kenya, Tanzania, Mauritius, and Ghana, Nigeria kind of made a commendable effort in that regard. And I think Gilles has talked about fines and penalties. The reason for encouraging compliance in Africa is because the fines and penalties could be huge, could be as high as 200%, or even worse. It's an issue that cannot be negotiated or discussed, especially if found wanting. We've recently seen tax amnesty programs come up, especially recently because of the downturn in the price of oil. So you've seen tax jurisdictions where tax authorities have given amnesty to defaulting taxpayers to come and pay up their liabilities, and they will waive the penalties for them. So we've seen that, and a lot of times it's usually program would last for probably cover 2 to 3 tax years, and it is important to note here that it's only penalties that they have agreed to waive and not the interest. So it's important to take note of complying on time.
Thanks, Omoike. Thanks for jumping in. I'm back fighting with technical issues, and coming back to your point on tax amnesty, I think it's something very important for foreign groups to follow that, because even if a group wants to be 100% compliant, there's still some mistakes that can be made, and tax amnesty offers a very good opportunity to kind of self-disclose the mistakes that have been made in the past. And by self-disclosing, in fact, these mistakes that have been made out of good faith, most of the time tax authorities in Cameroon would waive the interest and penalties. And like Omoike was saying, the penalties can be as high as 200%. There could be some fine in some rare circumstances. The offense could be viewed as criminal, so there might be some criminal penalties if the bad faith can be demonstrated. In addition to fines, especially in Francophone Africa, companies which are not compliant will also suffer very significant late payment penalties. Sometimes it's 1.5% per month. Sometimes it's higher than that. Sometimes there are caps on the late payment penalty, but sometimes there is no cap at all. So it can really reach out very, very significant amount. And once again, tax amnesty program offer a very nice opportunity. And at the same time, we have to admit that it is very difficult to be compliant, 100% compliant in some countries in Africa with regards to the number of taxes, in fact, which are enacted like the existing one, and every year, during the finance law, new taxes are being enacted, and it's not always easy just to get access to the information. In some countries, you go online, you find reliable, like for example, I don't know, in the US or in France or in Germany, whatever, in Europe, you would find reliable and sometimes even like free information online of at least, what are the taxes, what is the basis, what is the rates. But in some countries where which are currently, not as organized as we wish from a tax perspective, getting access to that information is already a challenge. And sometimes even when you go online and you Google, I don't know, what is tax liability in such and such country, you might find something like 6 or 7 different answers, which obviously doesn't make any sense. So one of the obviously one of the ideas is to work also with people who have the that specific capabilities, people who are connected on the ground, people who know, if a law in Mali, for example, was passed, last night, it's going to take some time before that law is published into, if it is ever published, but if it is published in the legal newspaper, it might take some time. So the only way to know about this new law and about this new tax or about the increase in the rate is to have a team on the ground who's reading the official newspaper every day and who would be able to report, in fact, that changes. Going back also to what Omoike was saying about compliance with employee and filing the monthly and annual returns, there obviously, and this is really not the topic of this webcast, but also to keep in mind that you cannot send people on business visa, for example, in Africa, if they are supposed to work over there. The rules are, in fact, very similar to the US one. You can go into Africa on a tourist visa if it is for tourists. You can go into Africa on a business visa if it is for a couple of meetings. But if you're going to be working on the ground, you need most of the time a local work permit and authorization to get into the country. That specific individual needs to be registered from a tax perspective, gets a tax ID number, also needs to contribute to the social security system, and then pay, a bunch of taxes, payroll taxes, and other. And that's one of the challenges. And every year, the World Bank and PwC publish a report on the ease of doing business in fact, in all the countries throughout the world. And I would encourage you to have a look at this report, and you will see that taxes, and especially the number of taxes which apply on businesses, are sometimes viewed as the number one challenge for foreign groups expanding over there.